Welcome back, everybody, to the Informed Homebuyer Podcast. As always, I'm your host, Rich Curtis. I've got my co-host with me, Dave Miller. Morning, Dave.
Good morning, Rich. Thanks for having me.
It is morning this time. I think last time I said that we
Yeah,
were recording in the afternoon. So,
yeah,
guys, today we're going to talk about sort of one of the most common questions we get in real estate is, how do I buy and sell at the same time? How do I work this out for my family financially? How does it work? And even more importantly, what most people really want to do is, how do I buy first and sell second, right? Because that's what everybody really wants to do. They want to keep the security of being in their home. They only want to move once, and they want to know they've got something, good and exciting locked up before they give up what they have. Most people don't hate their homes; they like the one they're in, and they don't want to give it up unless they've got something better on the hook. That's only human nature, but it poses a whole host of logistical and financial and lending challenges, and that's what we're going to walk you through today. Dave's going to bring the lending perspective, and I'm going to talk to you from the real estate side of things. So let's start with the easiest thing in the upfront answer, which is, it is always better to sell first and buy second, right? It is always a better idea. You have more negotiating power. You have a clear plan. You don't face all these logistical challenges. It's always better. The best way to sell a home is vacant and staged. That's when you're going to sell it the quickest and for the most money. Second best is staged and living in it, right? But the sort of the worst scenario of selling a home is, I'm under the gun because I already bought one and I've got 2 mortgage payments, and I feel like I gotta make any offer work because I don't want to make these 2 mortgage payments. So if you can sell first, have an interim housing plan, and then buy, that's sort of the best scenario.
yeah.
You're
And
dying to jump in there, Dave.
yeah, and I think because we've been doing this a long time, Rich, and uh, great advice, 100% accurate. And what we find is there's also those folks, those rare kind of handful that isn't thinking about selling or buying, but then they find this one house that they just love and they got to have it, right?
Yes.
And if they don't get that house, though, they're not going to sell. So, but still, if and we'll talk through a way to prepare yourself if you're even have an inkling that you might go out and look, or that something that your dream home might, or something that's perfect for you might become available, how to prepare yourself for that. So you are actually in a position to do that. So we've been doing this for so long, and it just happens more often than not that someone isn't looking to buy, and then they stumble into something that they just all of a sudden now they got to have it.
All the time. The whole last quarter, the final quarter of last year, was nonstop calls of, Rich, I found a house I want to buy. Come show it to me. And then, by the way, I need you to get my house sold. That was the whole final quarter of last year. And this happens more and more now because of the way we market homes. One of the things we talk about a lot, if you watch my listing videos, video is king. Having a really good, solid video marketing program gives you a really wide net for catching those buyers who are like, well, I'm not looking for a house, but if I found the right one, I would buy it. And with the video marketing, that happens more often to people. They're just popping around on YouTube. If you want to see how we do this, I've got a playlist of listing videos on the channel. You can see how we market our homes via video. But people are just bopping on YouTube. They see a house and either in their area or a nearby area they've been thinking about moving to, and they go, oh my God, that's the one for me. I just had a YouTube buyer do that. She was just bopping around, found this house, watched the video on YouTube, called me up, bought it that weekend. She wasn't looking to even move to Placerville, but she just fell so in love with this house. She did it. So yeah, that is something that comes up a lot more now, just because of the way we search for houses and how much more information. Back in the day, if you were in San Francisco and you want to buy in Placerville, you had to maybe look in the Land and Homes magazine, or the one realtor who was running ads in the paper. You couldn't just pop on the internet and watch a bunch of videos of cool houses in Placerville and fall in love like that. But now you can. So it happens a lot now. So yeah, if you can sell first and buy second, that's great. How do you do that? Well, you have an interim housing plan. You live with family. You live in a fifth wheel trailer on the property of your other family. You rent an Airbnb. You rent a short-term corporate apartment, that sort of thing. And yes, that Dave and I were talking offline before this. Yes, that Airbnb might be a little more expensive than your mortgage, but you can make that up by having more negotiating power on your purchase. And we'll talk more about that later. So your best scenario is always sell first, buy second. Now, 99% of you aren't going to do that because human nature is the other way. And to be honest, if I was to be moving right now, I would be doing it contingent as well, because I got 2 little kids and a business and a YouTube studio, and it'd be insane to try to break all that down, move into something temporary, and then move a second time. There's no way I could do it. So most of you are going to take some of these other options. Another one on the table, for you in terms of how do you do this is you just sell first, but you get a rent back, a short rent back, a 30 or 60-day rent back. And during that rent back period, we get out there and we find your home of choice. This puts you in the driver's seat. You have the money, you have good negotiating power. It does put you under the gun timeline wise. And if your home of choice isn't available at that time, you may make some compromises on your replacement home if you go that route. So that's another way to do this. But other than having a short-term housing plan or during doing a rent back, there's really not a lot of other options for the sell first, buy second plan. So now we're going to move into how do I buy first and sell second? And there's a lot of different ways to do that. And we're going to go through all of them, most popular being contingent. So if you're here for the contingent information, stick around. We're getting to that. We're going to move through these other less common versions pretty quickly so we can get to the contingent offer one, which is what 90% of you are going to do. But I'm going to move it over to Dave to talk a little bit about one option, which is bridge loans. Dave, how do they work? Who are they for? What do they cost?
Yeah.
What are the pros and cons?
Yeah, so I've been doing this a long time, Rich, and I'd say 99% of the time I presented a bridged loan to someone that wanted to buy first, then sell and qualify for both mortgage. So basically, a bridge loan is going to allow you to qualify. There's really no, it's a short-term financing that allows you to qualify to have both loans. They basically pay off your existing mortgage. And then that gets sold after your new mortgage, and they're quite expensive in terms of what we call points or percentage up front. And in the whole scheme of things, they sound expensive, but they're a means to an end, and it's a short-term cost that if you don't want to be displaced and you want to buy then sell later, it's a great option. And it just comes with a little bit of sticker shock. Someone says, okay, this bridge loan is going to cost you $12,000 for this loan. And I'm just throwing a number out there like, holy smokes, 12,000, no, I'll just wait, or I want to come up with another option. But it's just the cost of being able to get both homes at the same time until the home you vacated sells.
It's a convenience cost. Yeah.
It's a convenience cost. In many situations, it's well worth it, especially in really an appreciating market, or where you've taken advantage of a ton of appreciation. You just got to kind of write that off as like, hey, I had all this appreciation, I'm ready to move, I want to move, it's going to cost me a little bit more than I would like to, but it's a convenience and it's a means to an end. You just pay it.
Yeah, or for someone like me, who the pain of trying to move first and have a temporary housing situation, I would pay nearly
Yeah.
anything not to deal with that with my
Yeah.
kids and my business,
Yeah.
So yeah, it is good for that. And the problem this is trying to solve is if you don't qualify for two mortgages at the same time. So if your intent is to buy first, sell second, the challenge is you have to meet all the debt to income ratio and all this, and ability to make the payment for two mortgages. That problem's exacerbated by people usually in this situation aren't buying down. Most often they're buying up. So
Right.
you've got an even higher second mortgage payment than your original one. You've got even higher debt. That's the problem we're trying to solve. If you don't qualify for a whole second mortgage on your own, the bridge loan allows you to get a loan without having to meet those qualifications. Is that right, Dave?
That is correct. And there's other, I know I don't want to jump too far ahead here, but the moral of the story is always is have a conversation with us as early as possible, even if there's
Yeah.
an inkling that you might even go look at a house. And we talked about some people stumble upon it. It wasn't something that was in the plans, but if you have a trusted realtor and mortgage professional, stay in regular contact. And when we move on to the next HELOC or taking money out, we'll talk about the benefits of that. But it's really just good practice, I think, especially in this market, is to take advantage of that, even if you're not thinking about buying a house in the next year or two or making a transition. So we can really provide you some good advice, and these things aren't very expensive. These, some vehicles that you can do to prepare yourself and just get you ready to go.
Yeah. So first challenge of buying before you sell is having to qualify for two mortgages. So if you qualify for two mortgages, then it's game on. You just go buy the other one. and
Mhm.
then we backfill and sell yours. You have to have the ability and know that you're going to eat the cost of making those two mortgage payments for whatever amount of time it takes us to get your home sold. So we'll talk about why it's important to have your home ready to go before you take this on. But if you can do that, then it's no big deal. It's not that hard. Once you sell the other home, that loan goes away and you're good to go. You can even take proceeds from that loan and dump them in to lower your payment down. So Dave, talk about that. Like, what if I only have a small down payment, and so I buy, but I can't qualify for two loans. I buy that bigger house, but my
Yeah.
payment's really high because I didn't have a huge down payment. Now I've got a bunch of money in my pocket. Does it cost me to dump that money in and do like a rate and term drop my thing? You know what? How does that work if I want to move that money over after the fact to bring my payment into line with what my comfort is?
Yeah, I think you bring up a really good point, Rich. And that's why just a full discussion, and I've done this multiple times, where you want to buy a new house and you have plenty of equity in your vacating house. And so you could just and you always want to do this while it's considered your owner occupied before you've listed it. You've made the decision at some point, I'm going to list this house for sale, the house that I'm currently living in. It's exponentially easier and better from a rate perspective to get a loan before you've listed your house, before you've put it on the market to sell, and your intention is to be there for the foreseeable future. It's 3 to 6 months, possibly a year. Do that as far in advance as you can.
Yeah.
But I've been in those situations where someone says, okay, well, I'm going to, I qualify for both loans. I don't have a lot of money down. I'm going to buy this new house. And then when I sell my house, you have two options. Once you've sold your house and you have this new loan, if you've worked through me, we'll set it up where you could do a recast. A recast is where you've bought the new home, you have all the equity because your vacating home has sold, and you want to buy down your mortgage. And you don't want to just write a check to the mortgage company. Maybe you have a new $500,000 loan, and you ultimately want that to be 300,000. Well, you could write a check for 200,000 and pay the mortgage company. That doesn't lower your payment. The only way
Right.
that lowers your payment is if you do a recast. And there's a small nominal fee. It's a little bit of a process, but you can reduce your payment based on the new principal balance after you've paid down that loan. So that's one option. The other option, which we'll talk about again, which I think is really good, is, and everyone, if you qualify, should do a line of credit on your vacating home before you decide to list it. And now you could use those monies, and we do it as big as possible. So if you say you owe $200,000 and you're selling a $700,000 house, well, you do a 200 or 300 or a really good size home equity line of credit. You only pay on what you've borrowed, so you don't start making payments on that until you borrow money. It's like a credit card. You only pay on what you owe. You could use those monies. Now we have to count that as debt against you as the down payment or what you want to put on your new home, so you don't have to mess with that new purchase loan once it's done.
Yep.
Lots of options that we talk through. And the other benefit of doing that is, if you don't have a lot of cash, most of your down payment is sitting in equity. Pull that money out and make sure you're readying your home to maximize the sales price and the desirability of that home. And that's a conversation that they should have with you, Rich.
Yeah.
You know,
Yeah, like everything in real estate, there's no blanket advice that's good advice. And as you can see, this gets complex really quickly, but we do have a lot of options. So if you sit down with your lender, Dave can talk through the recast option, or you can talk through the pull money out in a HELOC option. What does it cost to pull it out in the HELOC? What's the most likely scenario? You get into a house, you've now used the HELOC money, so now you're starting to pay on it. How many months does Rich say it'll take to sell your house? We can compare those costs to the cost of the recast on the other side, right? We can
right.
we can also look at, do you have 401k monies? Do you want to borrow from your own 401k, right? And use that money for a down payment and then repay that out of your home. And what are the costs and fees associated with that? That's another, option. So Dave can lay all those options on the table and help you
Yeah.
pick the one that costs you the least and makes the most sense for your situation.
Right. Yeah, and I think I bring that up so often with people, and I think that it's my obligation to ask the questions when I'm dealing with someone, and I don't make any assumptions. And I've asked someone, "Well, do you have some family members that will gift you money, so that you could take care of this?" No, I don't have family members that are gifting me money. What do you think? We're the Clampets or whatever. You know what I mean? So, uh,
Yeah.
but I always ask the questions because I would hate to get down the road and be like, well, you didn't even present that to me as an option. So I'm always ask all the questions. Do you have a 401k? Well, if you have a 401k, that doesn't mean you could borrow against it.
Yeah.
Does it mean you could do a one-time home purchase? There's different. Call your 401k provider, ask what your options are, what the costs are. Oftentimes, if you borrow from a 401k and you borrow that money, you have to pay it back, but you're paying yourself back. So
Yeah.
those are things but I'm not an expert in your own personal 401k. I'm going to make sure that you talk to the appropriate folks there and also ask all the questions and get all your options available. Once they're all on the table, we can talk through which ones are best.
Yeah. So we have two problems to solve when you're looking to buy before you sell. One is qualification for the mortgage, and the other is, do you have the cash to actually at least scrape together the minimum down payment? And then how do you want to approach the rest of the down payment that bridges the gap to bring the loan down to your payment comfort? We have multiple options on that. So for qualification, we just went over how do you get the down payment money. You either can borrow from family, borrow from 401k, do a HELOC, a home equity line of credit, to yourself in advance of the purchase to get ready for that. Those are all ways. Or you can purchase with the bare minimum down payment and then do a recast on your loan after the fact. Dave can walk you through all of those options and which one's best for you. For qualification, we have a few levers we can pull there as well. So if you don't qualify for the two loans up front, we have the bridge loan option, which we already talked about, which comes at a cost. But there's also the possibility, and we did one of these last year for somebody, where you have, we might have done two of these last year for somebody actually, where you have a family member that can come along as a non-occupant co-borrower on the new loan to help you with the qualification until you refinance or until you sell. And then later on down the road, if that family member wants to be off that loan because they want that off their credit for other money moves they want to do, once you've gotten rid of that old loan, you can always refinance down the road. There's a cost to that too that you have to bear in mind, and get them off the loan so they can move on with their own, credit and purchase history. So talk people through how a non-occupant co-borrower works and what kind of non-occupant co-borrower is helpful, because a lot of
Yeah,
times it doesn't really work.
right.
More often than not, it doesn't work. So
More
talk
often
us
it
through
doesn't
that, Dave.
work. And the key to that is when you bring in a non-occupant co-borrower, it's typically a family member, a parent, or a sibling. But you have to bring in, you're basically trying to utilize their income to make your debt to income ratio so you qualify for both mortgages, but you also have to include their debt. So you
Yeah.
don't just get to use someone else's income and not include their debt. So,
Wouldn't that be
this might,
nice?
yeah, right. So this might be a family member, a parent, someone that has a house paid off and they have enough disposable income or verifiable income that will help your debt to income ratio. But to your point, there's risk associated for them in terms of now their credit is utilized. They're responsible for that loan as a non-occupant co-borrower, as a co-signer on that note. And the option is, yes, you can get them off that loan down the road by refinancing. There's fees associated with that. The other risk is you have a non-occupant co-borrower today, interest rates are 6.5%. You say, okay, once
Right.
I sell my house, I'll refinance and I'll take you off that loan. Well, what if rates go to 7.5%? So
Yep.
yeah, you could get that non-occupant co-borrower off there and your obligation to do so, but now you're taking a higher interest rate. So there's pros and cons, and we just talk through all the options.
Well,
Options
and
are
there's
good, and
yeah.
narrow them down to what you have available and of what's available, what your best ones are.
The risk we always talk about in association, whenever we talk about you could refinance down the road, the risk that a lot of realtors and lenders don't talk about, and we talk about on almost every podcast, is there is never a guarantee that you personally will qualify for that new loan down the road. You could have
Yes.
taken on a bunch of medical debt. You could have taken on a bunch of school debt in the interim. You could have lost your job, been laid off. All sorts of things could have happened
Or
that
the,
make
the
you.
yeah, or
What's
the
that?
equity's gone that you're going to use as the equity to refinance in that new, so
Yeah, you could have hit
that's,
a declining market and now you
yeah,
don't have enough equity to refinance.
right.
Correct.
Yep.
Yeah. And in a year like now, if you've been watching our podcast, we are facing down the potential, not the guarantee, but a strong potential of losing some real estate value over the course of this year. So this is one of those situations where someone looking to refinance could. I don't think we'll lose enough equity that would push anybody out of qualification in the next 12 months, but we are hitting a type of market where those sorts of problems could start to pop up. So the risk associated with the non-occupant co-borrower is not being able to get them off, or not being able to get them off at a time when the terms are what you would want them to be for your new loan.
Correct.
So So all of this, the final one, and then people always ask me this is, can we just do a concurrent close? And that is possible, right? The better version of the concurrent close is what I talked about earlier, where we get you a 30 or 60-day rent back, so we have some buffer. I mean, if you get an offer on day one on your house, and then we went out and on day 2 or 3 of escrow found your replacement house, and maybe we got a 45-day escrow on that and a 30-day escrow on yours, there's a potential of a concurrent close, but there's a lot of risk there. And it would be a whole podcast in of itself to try to explain the timelines involved here. But suffice it to say, there are dates certain where you have to do things like remove all your contingencies and what we call go hard on your deposit, where your deposit could be at risk. And if you lose your buyer after that point, now you could lose some money or lose the house. Your buyer could find a problem with your home that needs a construction project fixed that then pushes the timelines out too far. So you don't have the money to close a new house on time. And if you're after your contingency removal date there, again, you could lose some money or lose the house. It's our job as a realtor to process all those timelines for you, make you aware, and try to keep you out of any of those traps. But it gets very sticky and very hard. So a concurrent close with no buffer, essentially, other than maybe a slightly longer escrow, is very rare, very hard to pull off. Could we do it? Yes, but it is, in my opinion, not the not the safest strategy for you and your family financially, and not the best strategy to hang your hat on out of the gate. The sort of worst one I would take on would be the 30 to 60-day rent back version of trying to pull off a concurrent close, because the only risk there is maybe you do end up having to move twice and move into interim housing, but you haven't lost any deposit monies or inspection monies on a new property or all of that. So I would encourage you to mostly stay away from the idea of a concurrent close. What are your thoughts on that, Dave?
Yeah, no, I agree with you completely, Rich, and it just got my mind thinking, about being a contingent buyer and having a house to sell and thinking through, when you're talking about the concurrent, as the listing agent or the sellers on the other side on the home they're buying or they're selling to you, they're taking, just like a contingent seller, they're taking on so much trust and faith that you're going to perform.
Yes.
And oftentimes, the buyer's agent and buyers aren't, it's not the same agent, right? So there's, you're relying on agent communication. And that's why I think if you are going to be a contingent buyer and you have a house to sell, work, especially if you're in our area, work with someone like Rich, get that house ready to sell. Because if there's a really good agent on that other side, that's the listing agent, when you make an offer and you're a contingent buyer making an offer, they're going to do their due diligence on the house that you have to sell. They're going to look, is it on MLS? Was it priced right? Is it priced to sell? Is it in sellable condition?
Yeah.
But let
100%.
me look into the agent. Like, those are really critical things to consider if you're a listing agent or a seller when you're going to consider a contingent buyer. So it's
Yeah.
more than just saying, hey, I'm going to sell my house, I want to buy your house. There's a lot of preparedness that needs to go into that.
100%. We're going to talk about that even more. We're splitting hairs here because, a contingent offer, which is what we're moving into now, is a concurrent close essentially. But when people come to me and say, I want a concurrent close, they're talking about basically a contingent offer with very tight timelines. So
Yes.
the mechanism is the same, and all of the downsides involved in a contingent offer are present in a quote unquote concurrent close. It's just you're keeping everybody's feet to the fire with unrealistic timelines, and things can go sideways. If you're going to be contingent, if you're going to lose the negotiating power, which we're going to talk about in a moment, that comes with being a contingent offer, give yourself some breathing room. Don't try to be doing this
Right.
in a 30 to 45 day, lightning fast period. Sometimes it happens that way, and that's great for all of us. And with the market having been hot as it was as a seller's market, that's been much easier to pull off. Like I said, we did a lot of these, Dave and I, last quarter of last year, and I don't think it took more than 2 weeks to get an offer on
Yeah.
the contingent home for sale. So that's really great. But as we're facing a market where on market timelines are already increasing, are very likely to increase more, that's going to be harder, and you want to give yourself some breathing room. So I think it's a good transition into what is a contingent offer? How does it work? What are the pros and cons? How does it work from a lending perspective? So let's dive in. A contingent offer is simply, I have a house that is either for sale, but I haven't sold it yet, which is the best version of a contingent offer. Is my house is already listed on the MLS, like Dave was just saying. I can send over the listing to an agent. especially if you're buying in the same market, that agent sells in that neighborhood too. He can comp the house. He can look at the work I've done and be like, all right, this guy's, doing some killer marketing. He's priced it right. This thing's going to move. I feel confident, being an advocate for this offer to my sellers. Or if he thinks we're bananas and we're way overpriced, he can also make that recommendation, saying you shouldn't take this contingent offer, right? So already listed and ready to go contingent is kind of your best case scenario. Some people even wait until they have an offer. That's even better. I'm contingent. I have an offer. Here's a closing date. That is a really secure position for a seller to consider that offer. Sort of second best is I'm listed, but no offer yet. You can see what's going on. Third best, and the way most people end up doing it, is I've got my house ready to go, but I'm not listing this thing until I'm in escrow. And I'm writing an offer that says, we will be on the market within 7 days, 5 days, 2 days. I almost never go more than 7 days. Basically, if I'm writing an offer on a Monday, I'm going to have this thing on the market by this weekend, is what we're saying to a seller when we write those offers. The benefit to that to you is you don't have to even risk selling your home until you have a replacement home lined up, because of course buyers can back out for any reason within 17 days. Sellers in California, at least, and this works very different in other states. So if you're all over the country, you have to check with your professional house search. But in California, the buyers are really well protected, can back out for, really don't have to give a reason within the first 17 days. Sellers, they're locked and loaded. If you sign to sell your property to somebody, you are selling it to them unless they back out or unless they blow a single contractual obligation or timeline twice. They have to blow it. You have to give them a 48-hour notice to perform. They have to blow it again. Then you have to kick them out of the contract. It's very actually rare that happens. So as a seller, you're locked in. So the benefit is you lock up the new house before you're locked in. The negative, of course, to contingent offers is you basically have almost no negotiating power. It is an expectation that your contingent offer is going to come in full price and friendly terms. Doesn't mean that's what you have to do. You're always in the driver's seat to make the decision on your own offer. But if I'm a seller's agent and I get a lowball contingent offer, what am I going to say to my sellers? Don't bother. You got to wait for these people's money anyway. There's no benefit to you. Just keep it on the market, sell it to somebody else. If these people get their home sold in time, they'll write us another offer and they'll buy it too. There's really no reason to entertain that offer. So the advantage that you're giving them, the reason you're giving them to look at your contingent offer and to take the risk that you might not get your home sold or it might take a long time, is that, hey, I'm giving you what you want. I'm giving you full price. I'm giving you friendly terms. That's why contingent offers are negative from a buyer's perspective, because you lose all your negotiating power. Now when we go contingent, Dave, we still have to solve those lending challenges of being able to, qualify for the second loan that we talked through. So we've already come up with this plan first, correct?
Yeah. Yeah. 100%. And one of the things that I'll always do in that scenario, and it's worked out, knock on wood, 100% of the time, the way we planned it, the way I planned it, never said to someone they're going to qualify for a mortgage when they couldn't. Where it gets, because here's the thing: if you're going to buy a house and you're going to be contingent and you're going to sell a house, when you've listed your house for sale and you've accepted an offer to sell, you are, like you said, Rich, you're obligated after those 17 days to sell. The last thing we want someone is to be homeless. You sell a house and now you don't qualify to buy another house.
Yeah.
So
Once in 20 years, this happened to me, actually. What, like, this did happen. You didn't work. You luckily weren't working with this buyer, so you didn't have to weather that particular storm. But so this brings us into, what do you need to do to prepare to go out and shop contingent? And the very first thing you need to do to prepare is contact your lender. If you're in our market, like I say, give Dave a call. If you're not, get your full pre-qualification done, and including, most importantly, getting your credit pulled. Right, Dave?
Yeah. Yes, 100%. And I know that's a story and I know the story well. But the other part of that is I will get you 100% underwritten by an actual underwriter for the house that you're going to buy based on the sale of your house. So we know, it's as good as we can get without, a job loss or something crazy that happens. But the other place where a little bit of stress comes into play, and you are underwritten and you're going to sell your house, say you're going to sell your house for 500,000, you know how much equity you're going to have, you're going to buy this new house. Now, all of a sudden, your house isn't selling, or you got a little bit of a lowball offer. And instead of selling it for 500, you're selling it for 475. And because that's what someone's willing to buy. Now you're $25,000 less of what you anticipated having. We will have vetted those scenarios ahead of time that says, hey, if for whatever reason you don't get, are you still going to qualify for this new mortgage? If you don't get all the equity you're anticipating? So we kind of think forward all the possible pitfalls, so you're just not left, stuck with not an option.
And that is the benefit of working with people who've been doing this a really long time. I've been in the business over 20 years now. Dave, you might be over 25 now or close
Yeah,
to
20,
25.
25. Yeah, right at 25. Correct.
Yeah. So if you're working with a new agent right out of the gate because they're family or they're a friend and you want to help them out, if you're doing this kind of deal, a contingent deal, there is very little chance that that agent knows what they need to know to think through all these potential pitfalls and protect you properly. And I always tell people a good way to honor that friend of yours, if you have someone who's new in the business and you're not really trusting in them to do this, is have them refer you to someone in your market who is a veteran in the business, who has been doing it. And my recommendation, always have a video on my channel, how to pick a realtor. And I've been promising to do one on how to pick a lender. Dave, we should just do one together on how to pick a lender for people.
Yeah.
But
Yeah.
the basic criteria is someone who's been in the business at least 10 years or more, because this business, real estate, has a 84% attrition rate in the first 5 years, depending on, it bounces between 80 and 90% attrition rate in the first 5 years. Meaning if someone's been in the business less than 5 years, the likelihood that they're going to be in the business 5 years in one day is 10% or less. And they just don't know what they need to know to do the right job. If you've got a bread and butter subdivision home, a straight up sale, no contingency, and any monkey could get on there and comp your house in 10 minutes because 5 others like it have sold, and you want to help your new friend who just got a license, I think that's pretty safe bet to go and do that. But make sure they have some mentorship in their offer to help them. But if you've got a complicated situation like this, you owe it to yourself to really get some professionals involved. And so the reason that full pre-qualification that Dave's talking about, property address to be determined, is so important, because he's confirmed assets, he's confirmed credit, he's cleared out all of the things that would be an impediment to you getting the loan. He's vetted scenarios of, if we have a shortage, will you still qualify for the loan, so that you don't become homeless. The couple we were talking about, they were selling a house and buying a house. I told them to get their credit pulled. They didn't, because they had bought a luxury car 6 months before, a very expensive car, and they had their credit pulled, and they knew it was good. And I told them that doesn't matter. You got to still pull the credit. And they didn't listen, because they were close friends. All right. Close friends are never going to listen as good as clients who aren't friends. And we got into contract to sell their home, and we got into contract on their dream replacement home, and the lender pulled credit, and they had a 10-year-old, like $50 collection from T-Mobile that had been sold all the way down, not quite to Joey the knee breaker debt collector level, but damn close, bottom feeder debt collector, who was so green in his own business, he didn't know how to properly record that against their credit report. And the way he did it made the wife's credit score unreportable. She could have been 0. She could have been 1. We could have got the loan, but unreportable, they couldn't. Their buyers for their home wouldn't let them out of the contract to sell. They had 2 huge dogs in the Bay Area. The likelihood of getting a rental was very low for them and very expensive. It took us somewhere 11-ish, 12 lenders we had to go through over the course of 14 days. And luckily our sellers gave us the grace to do that. And we did get it solved, and they did get their home of choice, but it was incredibly stressful for them. So I can't stress enough that the first step in the process of selling contingent is to get with your realtor and your lender. Realtor can give you that price brackets and range from low to high of what they think is going to happen for your house. And the lender can take that and run all the scenarios for you and make sure you're good to go before we start shopping. So that is the absolute tip top most important. Second one is to get your home physically ready for sale so that we can list it quickly. If I'm going to say we're going to have it on the market in 48 hours to 5 days, you got to be able to do that. And it's better just do all that up front, so that with a couple hours of cleanup, I can bring in my video crew, my film crew, and we can have it on the market ASAP. So if you've done both of those and you've gone through the vetting process with Dave to figure out how you're going to finance all this, what you're going to do after the fact, what processes you're going to use, you have all those things in line with your realtor and lender team, then you can get out and sell, buy contingent, pardon me. And now I think Dave, well, go ahead.
No, I think I was just going to elaborate a little bit more on that in terms of that home equity line of credit and getting your house ready to sell. And we've seen this a lot, Rich. You can come in. It's okay for you to meet with Rich a year or 2 ahead of time. If you're like,
100%.
hey, I got kids that are a junior in high school or, sophomore, we know we're going to sell in 2 years. Let's get you that line of credit now. And let's do all those recommendations in terms of the improvements on the house with that line of credit, and enjoy the last couple of years of the house. You don't have to make it your dream home and then sell it. Like, make it how you really what Rich recommends is going to sell it best, and enjoy those improvements for the next, foreseeable future until you're ready to sell it.
Yeah.
Because we see that a lot.
And have the time to do it. If you're not handy and you're not going to do this yourself, construction timelines are insane right now in terms of, it might be
Yeah.
3-4 months before you, sometimes 6 months before, if it was like a big project, like right now
Yeah.
in Placerville, if you want a kitchen remodel, you're
Yeah.
gonna be between 6 to 18 months before that project starts.
Well, Rich, what if you have like a minor project and you're trying to buy a house and some deck work that needs to be done? Is that something that you can get done in a day?
Yeah, right. Yeah, we do. Yeah, we deal with this. We deal with situations in escrow where people have to tear decks off of houses and seal up doors because we literally, even if we have the money, we couldn't get it done in time to sell the house. We get under the gun. So if you have an old rotted deck, which these decks are the reason Dave's bringing that up, and it's funny, is because decks cause more problems than nearly any other component of a home, because most of these decks were put on when lumber was cheap, and they're massive, and now lumber's expensive and decks are really expensive. So, a deck on 30-foot long, by 10-foot wide deck costs 50-60 grand now. It's insane. So getting ahead of those kinds of things where you can say, well, what, I'm not going to live here, maybe I'm going to make this deck smaller, maybe I'm going to take the deck out and put a staircase in, maybe doing that years in advance, or at least 6-8 months in advance, where you still get somebody out to do it, is great. We had a deck almost wreck a transaction recently, but we found a contractor who could get it done. So being out in advance of these things for your financial preparation and then your home preparation is key. Once you've done that and we go to market and we find your replacement home of choice that you're so excited about, we still have a hill to climb in terms of you being a contingent offer. So when I'm a seller, what I want to see in terms of my favorite kind of offer down to my least favorite kind of offer, I want a cash offer. That's the best. Cash is king, right? I want a conventional normal loan offer, with hopefully, preferably 20% down or more, but 5 or 10%, that'll be all right. Then an FHA loan. After an FHA VA, probably about the same. And then after that, any of the other sort of, USDA, all these other random loan programs are kind of below that. And below all of that, way below all of that, is a contingent offer. It is the least favorite kind of offer for seller to see, and it is the hardest offer for a listing agent to advocate for and put their seal of approval on. And so as your team, Dave and I, and we'll talk separately about the things we do to help you with that, we have to advocate for that offer. We have to put you in the best position. So part of that is, like I said, having usually coming in full price and friendly terms, and knowing what friendly terms are for the area. Being able to send supporting documentation. If your property's on the MLS, I'm going to send the MLS listing and all of that. So I'm going to send them the video, because that is the crown jewel of my marketing program. So if I send them one of my YouTube listing videos, they're going to feel really confident that that thing's going to move, going to sell. If you're not listed, I'm still going to have some in the pocket photography, and I'm going to send them the photographs, the price we're going to list for it, that we're ready to go, the timeline we can list for, how long I think it's going to sell for. I can point them to comps, especially if they're local agents in the marketplace. And I'm going to send all of this up front with your pre-qualification or pre-approval letter from Dave that we've already done all the work for, and he'll talk about that in a second. And we're going to send all that up front as supporting documentation to give your contingent offer the absolute best possible chance. And I'm going to communicate on the phone. I'm not going to send blind offers, which I get this all the time. I don't know why agents still do this. Just get an offer that pops into my inbox. Don't know who you are. Haven't talked to you. Don't know anything about this offer. I'm going to call and advocate for your offer personally. And so is Dave. So I'm going to move it over to Dave here to say, what are the things on the lending side you're going to do to give this contingent offer the best chance of success that people can use if they're with us, or ask of their trusted professional in their market?
Yeah, that's a really good point, Rich. And so whether you're a contingent buyer or just non-contingent, if you're looking to buy a home, no matter what the situation, if you're going to submit an offer, 100% of the time, I will reach out to the listing agent, even if you're the only offer that's been submitted, and I will introduce myself. There's a good chance I've worked with them before. As Rich mentioned, I've been doing this near 25 years. And I will give them that confidence level, and I will share the key qualifications about you as the buyer. You've been underwritten with a property address to be determined. I work for SnapFi. We're a direct lender. We process, underwrite, fund our own loans. We control the process from start to finish. I have never once in 25 years pre-approved someone that I couldn't get a loan for. I will also have some understanding about the home you've submitted the offer on. Rich will bring me up to speed. Hey, there's a couple things that you should be aware of when an appraiser goes out there. Is this going to be an issue?
Yeah.
And what type of loan are we doing? So, there's all kinds of moving parts. And, I will, have a conversation. I will look at it, find out what the details are, and say, okay, well, just, have this done before ahead of time as a seller. If you're doing your repairs, make sure these things are done so an appraiser doesn't call it out and slow us down. So I just think it's important that you work with a team, and it's amazing. And if other lenders are watching this channel, when I call a listing agent and I have this conversation with them about your buyers and the confidence I have Rich as your agent, they're kind of surprised I gave them a call. Like,
Always.
oh, that's
Yeah.
great. I got your pre-approval letter. I probably was going to call you. I called them first and gave them that just level of confidence. But the other thing too is Rich can talk to this, and this happens so many times in a transaction. You submit an offer, Rich is working with the other side, and then the other side doesn't communicate with you once an offer is accepted.
Yeah.
You know what? Things happen. Let's just communicate everything that's going on, share information, but just disappearing and not answering questions. And I will tell a listing agent that you call my cell phone, call me regularly, email, text me, whatever. I will always be available. At the worst, it's going to be an hour or two before I get back to you. And I will be proactive. If there's anything that seems to be any type of hiccup, I will let you know so that you could be prepared and you don't look foolish in front of your seller, because almost 9 out of 10 times we're going to be able to work through whatever that potential issue is.
And that communication piece is so important, especially in a contingent offer, because, and we're not going to get in the weeds today about the functional aspects of a contingent offer, but suffice it to say, if it's done right, there's a portion of time that you have to get an offer on your home where they can't kick you out of the deal. And after a certain time, if you haven't got an offer yet, the seller could give you grace and give you more time, or they can kick you out of the deal. And that becomes the inflection point in a contingent offer. Is we haven't gotten an offer in time. It depends on the market. Hasn't happened in a long time because we've had such a hot market. But as the market cools, it could start happening again. That time period is usually 17 days. I said we're going to get into the details, and there I'm getting into the details. But a time period is usually 17 days. And in a slower market where it's 60, 70 on market days to get an offer, and we're hustling trying to get it quick, we could start to blow that timeline. And whether that seller gives you grace and more time or not to sell is going to be dependent on their own personal pressures and timelines, but it's also going to be dependent on how they feel about you and your representation and what a job that you're doing. And so if every week I'm telling, we've had this many showings, I've got people talking offers, here's what's happening, Dave's keeping them updated, I'm getting new pay stubs. Every time a pay stub comes out, I'm staying on top of their qualification. Employment's still good. Everything's good. And we're keeping them updated as we go. If we hit that inflection point, if you haven't sold your house yet and you want more time because you still want to buy this house, we have someone who's like, man, these people are communicating. They are executing. They're getting stuff done. I feel confident that, yeah, they just need a little more time, but this is a team that can get it done. That can really make the difference between you staying in and staying out. So whether you're working with us or you're working with your trusted professional in your market, wherever you are in the country, you want to make sure that your team is communicating regularly every week with the sellers on the home you're trying to purchase. So,
Yep.
and having upfront, having the what Dave was talking about, the pre-approved property address to be determined, also puts you ahead of a regular offer from a buyer, getting a loan. They might just have a pre-approval letter. I mean, they had a 15-minute conversation, Dave. So actually, Dave, you'd be better off doing this. Talk about the difference between just getting a pre-approval letter or getting or pre-qualification letter or getting, fully pre-approved property address to be determined, because
Yeah.
people like me are going to look at that differently.
Yeah. So a pre-approval letter is basically a lender representative like myself gathering some information from you as a potential buyer and issuing a letter that says you are pre-approved. That means I've looked, but as Rich talked about the attrition in this business, you could have someone, and I've seen it happen multiple times, issue a pre-approval letter based on they think you're qualified, but they missed something. There was something that was missed. They didn't calculate your income properly. They used your bonus income, but they couldn't use it. They used your overtime income, but they couldn't use it. They used your, whatever it might be, and they qualified you and you weren't actually qualified. So I've been doing it a long time. I would say, 99% of the time when I calculate someone's income and I do the pre-approval, it matches when I send it to the underwriter. The underwriter is someone that's going to validate and look at all the guidelines based on the loan program and make sure we've calculated everything correctly. So whether it's a traditional Fannie Mae or an FHA or a VA loan, you have to underwrite to those guidelines, and there could be different guidelines on how you do calculations. And so I want that confidence level that once this loan gets offered, submitted and offered, it's like Rich said, it's almost as good as cash. It's been looked at by an underwriter, it's been validated. And then that underwriter can tell me if we need to do something a little bit different. And it might
Yeah.
be like, it might be in December this year and you don't have a 2-year history of overtime or pension and you're ready to get another W-2, all of a sudden you've reached that milestone. So we just got to wait, for the next pay stub or the next, 40 days. And now all of a sudden we could use that income. So there's a lot of things that we can vet ahead of time, but it's really critical to get that underwritten with a property that's to be determined, because that is, the next best thing to cash.
Yeah, and that's probably going to be next to reviewing your home to make sure they feel like it's sellable. That's going to be the next most important criteria of whether that listing agent we're sending this package to is going to advocate for your offer to their sellers or not, is that you've been fully vetted through this lending process. And it's especially important if you're executing one of the other things we talked about earlier in the pod, like a non-occupant co-borrower. Maybe your non-occupant co-borrower is a family member who's a business owner. And now we're doing like K1 income, not standard W-2 income, and things just got orders of magnitude more complicated. This is going to take an underwriter longer. There's going to be some back and forth between the underwriter and Dave and your non-occupant co-borrower about how we're going to document this income and more things we might need, more paperwork we might need. These things can get complicated fast. If we've done all that work up front, so we know it's airtight, that gives that seller real confidence that the only thing they have to worry about in this transaction is whether we get a buyer to close quick enough on your replacement property. So that doing that loan piece up front is absolutely critical anytime, frankly, you're buying a house, but especially when you're going contingent and you have this much complexity.
Yeah, and you brought up a point earlier, Rich, and I'll reiterate. Someone that's been in the business, have we seen everything? No, we still get some surprises that pop
All the
up, and
time.
all the time. But there's so many things that we just take for granted that we've seen and we're already prepared for that. So it's a non-issue where it would become an issue for someone else that hasn't seen it, been there, and done that. So, we don't even think twice about some of these things. We're already prepared and we've checked the boxes on those.
And working with someone who's a direct lender, that is a benefit over someone who may be a broker, because all this is in-house today. If we have a condition that might be a prior to funding condition, meaning there's a problem you, Mr. Buyer, have to solve, prior to docs condition, before we'll even give you the paperwork. Sometimes Dave can move that in-house to a prior to funding condition to buy us more time and not slow down the process. If we're dealing with K1 income, if we're dealing with something that's more complex, he's right there with the underwriting team. They can go back and forth in-house. There's a lot more leeway and a lot more ability to solve these problems.
Yeah, even a step further is we could do post-close conditions if we know what's coming. And my underwriting team, I've been with the same company a long time. If I say, yeah, I'm going to get this, the borrower already, confirmed they're going to provide this for me. Let's fund the loan today. I'll get that for you on Monday, and they'll do it.
Yeah, I had that years ago, even on my own loan, because I was in real estate where they said, yeah, everything looks good. We're going to close this up. But after close, you got to send us the closing statements for your last 5 closings to prove you weren't lying, or whatever. And I had to send a bunch of paperwork after close. Those of us who are self-employed have to jump through more hoops. So yeah, that's a really great flexibility to have. There's differences between going to B of A, going to your credit union, going to a broker, or going to a veteran direct lender. And that could be a whole podcast in and of itself. But as you're shopping in your market, if you're not in our market, call Dave. But if you're not in our market and you're shopping around, we can refer you to someone great there and vet them for you. But if you're going to do it on your own, looking to work with a direct lender is a really great way to know that you have more control over the process. So from a 30,000 foot view, we've gone over a lot. This has been kind of a dense episode, but most of you, 90% of you, are going to end up going the contingent route. You're not going to go, the bridge loan route or some of these. Most of you are going to end up contingent. So this last part of the pod about contingency is specific to you. And for the vast majority of you, you're going to go contingent and not on the market yet. So the main things here, the takeaways are: get your realtor out quickly, get your lender out quickly, get the home prepared for sale, and get yourself all the way pre-approved, property address to be determined. And that gives you the best chance to go out and get your home of choice and execute this fairly complex process cleanly and smoothly and without hiccups.
Yeah.
Um, all right, guys, I think we'll wrap it there. If you have more questions about this, feel free to reach out to us directly to vet your own personal situation, because those are all different. If you have more general questions, or if this podcast brought up something that you don't know and you want us to address, put it in the comments down below. We will address questions in future episodes for you. We're here as a resource to help you be a better informed home buyer. So put them down there in the comments, and we will answer those in future episode. As always, you made it 50 minutes with us. That's pretty amazing. You are either a sadist, or you needed help sleeping, or you're deeply committed to your own financial education. Either way, we appreciate you making it to the end with us, and we'll see you on the next one.
I'm Dave Miller. Thanks.
Rich Curtis. Bye, guys.